Our impairment levels are very low. We're not seeing any signs of real distress or deterioration. Incredible resilience among households and businesses, so very low levels of impairments. Obviously, a lot of discussion around and activity and proactive contact with helping people manage, cost of living and higher interest rates and inflation. But in terms of our book, very resilient, very robust, and very limited signs of distress.
Where you have been making impairments, where have they been focused?
Well, they're very limited. Actually, what we've seen is in the very low levels of impairments, and they're way below pre-COVID level. It has been in people who've been in distress previously. And actually, in most instances where we are seeing people move into what we call heightened monitoring, it's not really cost of living. It will be the impact of the economy plus a life event. That tends to be where we see people moving into needing help from our financial health and support teams. So underlying macroeconomic or sector levels are not really driving in. Obviously, we're keeping a close eye on those sectors that are most impacted by inflation or consumer spending, but we're really not seeing any sort of deterioration or trends coming through at this point.
Now, when we last spoke, you said you thought that the Bank of England bank rate would peak at 4%. What's your thinking now?
Yeah, I mean, obviously, there have been further rate rises and the trends are saying maybe one, maybe another two rate rises coming through. I think it really depends on where inflation comes through. Certainly, we're seeing the latest assumptions saying it may go up to, another rate rise, maybe two. So it really depends on how quickly inflation comes down.
Now, the net interest margin, which of course is the difference between what you charge borrowers and pay depositors, is up to 3.27%. That actually came in lighter than some in the market was expecting. What were the factors at play there?
Yeah, it came in exactly where we thought it would come in. That was broadly the guidance that we said, and we've given guidance of what it will be for the year. Clearly, what we're balancing is the interest rate that we pass through and the growth on our book. What we've seen in this quarter is very strong growth in lending, 5.7 billion deployed into the economy on a very balanced way. Deposits are a little bit lower in Q1 as we expected them to be. It's a period where there are big tax payments that come out. We're seeing really rational and sensible behaviour by consumers in terms of managing some of their debt and maybe prepaying some things down, and a little bit more competition coming through. So, but we're pretty comfortable with where it's come through. I think people expected us to upgrade, but we remain confident with the guidance that we've given to the market, and it is early in the year.
Now, last year you raised your share of the mortgage market, and it looks as though you're continuing to trade above your long-term average.
Yeah, we've seen our mortgage share increase from 15 to 17% in Q1. As you know, last year during that period of real market volatility and disruption, we made the decision to stay in the market when a lot of our competitors pulled out. We thought that was really important for customers given the huge uncertainty that's there. And you're seeing some of that flow through into our market share. We're very competitive. We're there supporting our customers, doing it responsibly. Our average loan to value on our mortgage book is 53%, but we are seeing good growth. And that's really what I've talked about with the position of NatWest. We have the capacity to grow, a really resilient and well-diversified balance sheet, which means we're robust and able to support our customers. And that growth is what you're seeing coming through in our book.
Now, you saw £19.8 billion worth of deposit outflows during the quarter. What was going on there? Is that customers eating into their long-term savings, spending those savings?
Well, there's a number of things going on. Obviously, in Q1, January, February, it's a big period when tax gets paid, and we've seen more people caught in the tax bracket, so big tax outflows, which are normal seasonal flows. We have seen customers proactively paying down some of their debt, a little bit of mortgage prepayment, a little bit of more expensive debt being paid down. And we are seeing a little bit of system liquidity come out where, people are using maybe a little bit of that buffer they built up during COVID to continue spending and absorbing inflation. position. But we're generally seeing customers economizing sensibly and good decisions happening around their balance sheet. So it's a combination of those three things of what we're seeing across the market.
And more broadly, how are you managing costs in this inflationary environment?
We're managing costs in a really disciplined way. We've given guidance that we expect our costs to be around 7.6 billion for the year. We've had higher costs in the first quarter, which are really, some of the targeted interventions that we've made to help with cost of living in terms of one-off cash payments to staff, and also our exit from Ulster Bank, which, as you know, we're withdrawing from, some of costs coming through strategic costs as we accelerate that.
Obviously, AI is a very, very hot topic right now for businesses of all shapes and sizes. Is that informing the way that you look at the business very much?
Well, I think AI offers, some interesting opportunities. Machine learning, the element of AI that we use quite a lot. We have Cora, our chatbot, which we've had in place for some time, uses machine learning, natural language processing. We use robotics a lot now in terms of some of our customer journeys as we have digital. Obviously, we're keeping a close eye on some of the developments around looking into the future. GPT obviously is something we're looking at, but I think it offers real opportunity and making sure we're balancing sort of some of those innovations and how they can inform the future.
Now, your Common Equity Tier 1 ratio, which is a measure of how much capital you're holding at the moment, you set a long-term target for that of 14%. You're actually above that now. Is that money burning a hole in your pocket?
Well, our guidance is we're aiming to be around 13 to 14%. That is reflective of the strong risk discipline we have across the book. I've been really clear that my intention is to distribute capital to shareholders. In our 14.4 that we've announced in Q1, it is above guidance. It shows the strong capital generation in our business, which means we're well positioned to participate if the government decide to do a directed buyback, which we have permission for. And obviously, I've already committed to capital distributions or any other opportunities it may present. But the good thing is our business is generating capital. We have really strong franchises, good risk discipline, and that gives us the opportunity to invest and distribute capital to shareholders or any other opportunities that may present themselves.